when AI-fueled equity optimism meets higher real yields and fresh energy risks. Cross-asset trade-offs change quickly. Welcome to vTalkInsight, Allocator's Lens Daily for June 22nd, 2026. Let's start with equities, where that tension is most visible. In equities, the core story is that the AI boom is still doing the heavy lifting for global indices, even as macro and political risks build around it. U.S. stocks continue to outpace Europe, supported by expected earnings growth near 20% this year versus roughly half that for European markets. Recent S&P moves have been choppy, but with volatility gauges back in the mid-teens, the backdrop still feels more like rotation than a full risk-off turn. The upside narrative is powerful. AI-related capital expenditure is projected to approach $1 trillion by 2028, underpinning robust demand for semiconductors, data centers, and software. One prominent projection puts the S&P 500 at around 8,200 by the middle of next year, assuming AI earnings momentum holds and the Federal Reserve avoids a major additional tightening push. The United States also looks like a relative macro winner, combining energy exports with leadership in AI, which reinforces the idea of U.S. equity exceptionalism. Against that, the risk side of the equity ledger is growing harder to ignore. Roughly 40% of clients are described as heavily exposed to fewer than 10 stocks, a reminder that portfolio concentration is high just as regulatory and geopolitical risks for big tech are increasing. Company-specific moves underline the dispersion. Accenture dropped about 20% on weak revenue and worries about AI disruption to its business model, while ASML has been hit by concerns over export controls, contrasting with gains in Vestas and Novo Nordisk on upgrade and growth news. European equities are trying to close the gap, helped by energy stocks outperforming on the back of higher oil and persistent tensions around the Strait of Hormuz. Some strategists see meaningful upside for Europe if Middle East peace efforts hold, but the evidence also shows that the core AI trade remains centered in the U.S., which may cap any rapid European catch-up. UK-specific political uncertainty adds another wrinkle, with sectors such as home builders, utilities, and banks facing policy overhangs, and trade frictions like the U.S. investigation into German healthcare legislation creating additional headline risk for European defensives. For allocators, this all points to an equity landscape where AI-powered upside and growing dispersion coexist, making the link to rates and currency moves crucial as we turn to bonds. In rates, the main shift is a more hawkish tone from the Federal Reserve under new leadership, which is restoring some inflation-fighting credibility, but also pushing U.S. real yields higher. A stronger focus on bringing inflation back toward target, combined with talk of unconventional tools, such as higher reserve requirements, points to tighter financial conditions, even if the policy rate itself stays on hold. Higher real yields are already weighing on more speculative assets and feed directly into both the dollar and discount rates applied to long-duration growth equities. Across the Atlantic, the picture is more mixed. European government bond yields have edged up, but softer growth in oil stabilizing in the mid-$70 to $80 range have reduced expectations for further European central bank hikes, with some commentators seeing scope for bond relief over the next few quarters. By contrast, UK gilts sit at the intersection of political noise and limited fiscal space, with 10-year yields around 4.8% and curves shifting higher as investors reassess the risk of policy mistakes. The Bank of England is signaling a more dovish stance than either the Fed or the ECB, appearing willing to tolerate above-target inflation for longer given weak growth and a soft labor market. Recent inflation relief from earlier oil price declines and a partial de-escalation in the Middle East gave the bank some breathing room, but renewed tensions and stubbornly high food prices limit how relaxed it can be. Markets read the message as a prolonged rate pause, yet they also know that UK politics can produce sharp gilt sell-offs if leadership transitions or fiscal plans surprise, so volatility risk around UK rates remains elevated. Those sovereign dynamics feed directly into credit, where political and fiscal constraints are increasingly central to spread pricing. Credit markets are being quietly shaped by fiscal maths and political fault lines, most visibly in the UK. The country now carries a high debt burden and the highest borrowing costs among the G7, leaving very little room for large-scale fiscal expansion without provoking a bond market response. Commentators stress that whoever controls the Treasury, policy will be tightly constrained by gilt investors and internal party politics, meaning ambitious spending plans face a high hurdle. Within that framework, sub-sovereign risk is moving onto the radar. Plans for Scottish government bonds are expected to come with a 50 to 60 basis point premium over gilts, reflecting higher perceived fiscal and political risk. The prospect of a renewed independence referendum could widen those spreads further, as seen in past episodes such as Catalonia, and may eventually feed back into the UK sovereign rating if fiscal transfers inside the Union come into question. On the corporate side, regulatory and trade actions are an emerging driver of credit differentiation, particularly in Europe. The U.S. Section 301 investigation into German healthcare legislation raises the risk of tariffs for large pharmaceutical names with significant U.S. exposure, while ongoing scrutiny of ASML and export controls on advanced chip equipment highlight how geopolitical tensions can impair balance sheets and funding costs. Overall, credit spreads still appear anchored by demand for yield, but pockets of political and regulatory risk are creating a more nuanced, issuer-specific landscape that connects closely to currency and equity narratives. Foreign exchange markets are translating these policy and growth divergences into a stronger dollar and pressure on several key counterparts. A more hawkish Fed, higher U.S. real yields, and resilience to global shocks are all cited as reasons why the dollar is likely to stay firm, with some banks explicitly expecting further euro weakness from here. The stronger greenback is already tightening global financial conditions, raising funding costs for non-U.S. borrowers and acting as a headwind for parts of the risk asset complex. Sterling sits at the center of several cross-currents. Political instability, including speculation about labor leadership changes, has led many strategists to turn more cautious on the pound, with some arguing it screens as the most overvalued G10 currency and is vulnerable to further weakness. Others note that sterling now trades near the bottom of its yearly range, and that, absent radical policy shifts, the scope for additional downside may be more limited, especially as much of the political story is already in the price. The Bank of England's dovish bias relative to a more hawkish Fed, however, points to a bias toward underperformance in the near term. The yen remains under pressure as well, as the Bank of Japan's modest rate hike has still left deeply negative real rates and easy financial conditions. That has encouraged momentum traders to lean into yen weakness whenever key technical levels break, reinforcing the global carry trade and adding another channel through which U.S. yield moves transmit to other markets. Together, a firm dollar, a soft pound, and a weak yen amplify the impact of higher U.S. real yields on commodities and emerging market assets, setting the stage for how energy and metals trade in the months ahead. Commodities, and oil in particular, continue to trade with a significant geopolitical risk premium despite recent price swings. The closure and partial reopening of the Strait of Hormuz have shown how quickly energy flows can be disrupted, and even with some shipments resuming, tanker bookings remain subdued, and traders expect it could take 6 to 12 months for supply chains to normalize. Oil hovering above $80 per barrel reflects not just current demand, but also embedded worries about future tolls, Iran's enhanced leverage over shipping lanes, and the fragility of ceasefires around Israel and Lebanon. That energy premium is feeding directly into broader inflation dynamics. Higher freight and fuel costs are lifting prices across the global food supply chain, from fertilizer, where Morocco faces export disruptions, through to supermarket shelves, with UK food prices still about 40% above 2019 levels. History suggests such price jumps rarely fully reverse, implying a persistent drag on real incomes even if new shocks are limited, and reinforcing the challenge for central banks trying to reconcile inflation targets with growth concerns. At the same time, higher U.S. real yields and a stronger dollar are undermining the case for traditional safe havens like gold and silver, where several commentators now see further downside risk if the hawkish Fed narrative persists. On the positive side, fragmentation in energy sourcing and surging AI-related power demand are creating a structural tailwind for renewables, with wind turbine makers such as Vestas singled out for strong momentum and potential guidance upgrades. Some argue that, in macro terms, the scale of AI investment now dwarfs the economic impact of sub-$100 oil, suggesting that while energy prices remain an important inflation input, they may be less capable of derailing the cycle than in past decades. For allocators, watching how the oil risk premium, food inflation, and renewable build-out evolve together will be key to understanding the next phase across asset pricing. Stepping back, the cross-asset picture today is one of powerful but narrowing AI-driven equity strength set against a backdrop of higher U.S. real yields, a firmer dollar, and a re-emerging energy risk premium. Equities still offer upside in the base case, especially in U.S. AI and related infrastructure. But concentration, regulation, and geopolitical tension are adding more idiosyncratic risk to stock selection and regional allocations. In rates and credit, bond markets are reasserting discipline, particularly in the UK, where limited fiscal space and constitutional questions are increasingly reflected in gilts and potential Scottish spreads. FX channels those divergences through a strong dollar and softer sterling and yen, tightening financial conditions and feeding back into commodities, where oil, food, and renewables form a new triangle of inflation risk and opportunity. Over the coming weeks, allocators will likely focus on how far real yields rise from here, whether Middle East energy routes stabilize, and how quickly AI earnings can broaden beyond the current leaders. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.